So are you looking to buy a business or looking to sell? There's a lot of factors to look at. It's best to speak to your accountant and lawyer, but let's have a brief overview and I'll provide some information on how it works. There are generally two ways of buying a business. One way is to buy the business assets and goodwill, or two, buying the shares of the company. Businesses are usually owned under a company or some sort of entity, and what you essentially have in that business is the assets, the employees, the liabilities, the expenses, the income, the client base, as well as the goodwill and plant and equipment. If you're buying the assets of the business and the goodwill, you're essentially just taking parts of the business and ripping that out of the company. When you're buying the shares of the business, you're essentially taking everything. Usually, buying the plant and equipment and goodwill is actually pro-buyer, whereas buying the shares of the company is pro-seller. So when you buy the plant and equipment of the business and the goodwill, it's actually beneficial for you because you're only ripping up the good things of the business. Usually when you go into a business, you want that equipment, you want the goodwill, which is the client base, the reputation that you're buying. Whereas when you're buying the company itself, you're taking over all the liabilities as well, which is quite risky for a buyer because you just don't know what type of expenses and what type of potential claims that could happen on that company. Obviously, if you do take over the shares, you would assume more of those risks and assume more of those liabilities. So it's better to do a lot of research when it comes to taking over the shares. In the point of view of the seller, then what they want to do is wash their hands and get rid of the business and get as much as they can. And as a result, if selling everything is quite simple as just selling their shares for the company. A great thing about selling the shares is that it gets taxed in capital gains. They will get a 50% discount if they've owned the business for more than 12 months. So for example, they sold the business for $500K, in which they transferred their shares over to the new buyer. That would mean that they would get 50% discount on that $500K and only pay tax on $250K, which is quite beneficial for them. In terms of the buyer, if they bought the business with just buying the business assets and goodwill for $500,000, it's actually beneficial for them in tax purposes because they get to value the plant and equipment at some certain value, and they actually get to tax depreciate the value of the assets over the lifetime of those assets. So for example, if they purchased the assets of the business, it was valued at $500,000, goodwill was zero, and the assets of the business would be used for 10 years of its life, that would mean that they'll get a $50,000 tax deduction for depreciation every year. Whereas if they were to purchase the shares, they wouldn't get to claim that $50,000 or $500K, only get to claim that when they sell that business. But it's not always bad things when it comes to buying the shares for buyers. Some buyers will prefer to buy the shares of the business. The reason why is because of the reputation and the history. You are basically prolonging and keeping that company going. There have been some companies out there that have been running for 20 years, 30 years. You're buying that history as well. So when you go and speak to the banks or when you go and speak to potential investors, they like that reputation. So as a result, it's easier to get loans, it's easier to get investors, even clients would love that reputation. So there are times where it's actually beneficial to buy the shares. So these are the two main ways to purchase a business or sell your business. Definitely best to speak to your accountant or lawyer or get professional advice to work out what's the best way to sell or buy a business.